And you are not wavering one bit on your bullish call on stocks. Why not?
Well, I think this is an environment where patient capital is really going to be the best strategy. I mean, we've had pretty bad setback on the data in the past few days, so I think it's understandable for stocks to be weak. But I think one of the things that we're still constructive on is the idea that states can open safely. We're already seeing that with New York, New Jersey, Connecticut, Michigan, Maryland. But safely opening does include taking the right mitigation measures. And so I think at the end of the day, we've had a setback, a lot of cases. It's not good what's happening in Florida, Texas, but we're watching deaths which are lagging. And I think many states are taking the right steps to open safely. And if you can open safely, you don't have to roll back all this progress. And as Stephanie had pointed out, there's a lot of data that's showing pretty good resilience. And you can get a resilient recovery even if we're still wearing masks and social distancing.
Yeah, but earlier this week, though, you suggested that stocks were, in fact, overbought, way overbought, and we need a consolidation.
Yes, I think that's absolutely appropriate because, one, the data, look, we've had the worst stretch of data since late March. I mean, this is not good data. We're at quarter end, and as you know, there were some folks who were pointing out there's going to be some selling into quarter end, so it's going to be sloppy for the next few days. And yes, I think it's important for the market to sort of digest these gains, but there's some critical levels that matter. I think the 200-day, as long as we're holding that, that's really good news. And interestingly, even today with the sort of the Facebook news, it's really highlighting that there is maybe more political risk in some of the names that people use as bond proxies. And that's why I think if the opportunity will end up really in the third quarter being the more cyclically sensitive stocks.
Yeah, you're still urging people to stick with these so-called epicenter stocks, which, by the way, have gotten smoked this week. And I want to tee up a debate because Josh said something earlier that I thought played perfectly into the conversation I want to have with you. But just so people know what I'm talking about when I say getting smoked, the cruise lines are down double digits this week. Retailers, airlines, builders, hotels, casinos. I don't need to go through all the names. You know the ones I'm talking about. The losses across the board in those names have been significant. And Josh used a word earlier to describe those names. He called them rentals. Tom, you view those not as rentals, as things that you should own. And I feel like there's a real difference in the way that those stocks should be viewed. Yes, they've had big comebacks. Why should people stick with those when we're talking about record number of virus cases in big states, which are dialing back their openings, and who knows what comes next?
Yeah, I mean, this is, again, really a matter of perspective. The U.S. and the world is going through a crisis that's never been seen in 5 lifetimes, probably never seen in 5 lifetimes. This is worse than the Great Depression. And if these companies aren't destroyed both on the equity and the credit side, but especially credit, I think that they're a lot more resilient than people realize. And I think that unkillability—
That's a big F.
Yes. Yep. The future's uncertain, Josh. So I agree. I can't say with certainty what anything looks like in 12 months. But if they're showing durability here, these are actually very attractive companies because they've survived the greatest stress test, in over 100 years.